Welcome to our FOMC live stream, and I'm going to go through things in the normal order. So we'll have my summary of what the Fed said and why they said it and my opinion about it, and then we'll get Ted up here to have some snacks, and then we'll turn it over to your questions and we'll have a Q&A. You can ask about anything, but why not ask about monetary policy, because that's what the live stream's about. So let me start off with the summary of what happened. So markets were expecting, with I think a 98% probability, a cut, and that's exactly what we got. So a 25 basis point cut. So obviously the President of the United States is going to be very happy about that. Not as happy as he'd be if it was a huge cut, but of course with the current FOMC membership, that's not going to happen. But there were tensions, and we'll talk about that later on. But the most important thing, I think, if we read through about what's going on in the economy, is that growth is still okay. Growth is described by the Fed as moderate. So GDP over the last half has been around 1.6% annualized, which is slightly slower than it was last year. 2.4% is what we had last year. Consumer spending is firmer than people expected, so that's a good thing. Remember, that's really critical to the US economy. People going out to the shopping mall, spending, that's very important. Business spending in equipment and intangibles is still expanding, but housing, that sector, remains pretty weak. Now remember that Trump is a housing guy, he's in real estate, that's his background. So that's one of the reasons, his justifications for wanting lower interest rates, which is of course stimulative for the housing market. But certainly at the moment what we're seeing is a weakness in that sector. There was mention of the government shutdown and its effect on the data, which feeds into the Fed's decisions, which we'll also talk about. But at the moment, they are expecting a small negative impact on growth while that shutdown lasts. But of course, they expect it to be temporary, and usually things pick up after the shutdown ends, if it's like ones we saw in the past. So that's the growth summary. Okay. Slightly weaker, not amazing. Jobs. Now that's more difficult because we're not getting all of the data that we'd normally get. Some of the surveys have just not been coming through because of the shutdown, but it does seem as if the labour market's cooling. Not collapsing, but cooling. Unemployment is around 4.3%. Hiring and layoffs both low. So what we have is a system which is kind of clogged. We're not hiring lots of new people, we're not laying off existing employees, but it's kind of stagnant in that sense, so not a dynamic market. Now, there's a lot of discussion about the reasons for that. So on the supply side, we've got less immigration. Of course, that's one of the policies that Trump has championed, but we also saw it under the previous Biden administration. But we also see a lower participation rate, which is a cyclical indicator. If the economy is weakening, you tend to see lower participation in the jobs market. So the people who could work may choose not to work. And at the same time, what you see, so less supply, but also less demand for employees. Now that's slightly more concerning because it shows weakness in the economy. Of course, some of that is by design because the Fed controls the demand side of the economy, not the supply side. And so if they have a slightly restrictive policy, then you'd expect a slight weakening in demand for jobs. So almost by design, that's what the Fed would hope to see. But clearly, there is a risk that they go too far and that the jobs market weakens too much. And that side of the mandate, which is full employment for the Fed, is starting to look more worrying. So in terms of the risks which the Fed sees right now, it's shifting more towards a risk of a weakening of the jobs market. And that was one of the primary reasons why they decided to cut today. Inflation's not hugely worrying at the moment, but the weakening of the labour market was more worrying. So that's why they cut. So downside risks to employment have certainly risen in recent months, I'd say. The third thing is inflation. Now, it's not crazy like it was in 2022, but it's still a little bit above target. So again, difficult to judge because of the difficulties with data. But the primary measure which the Fed looks at is called core PCE inflation. That's personal consumption expenditures inflation. Now that's roughly 2.8% year on year. Remember their target's 2, so slightly above target. Goods inflation has picked up because of tariffs. Clearly, that's going to be a transient thing. Eventually, the new tariffs are going to work their way out of the system. Inflation is a year-on-year change, so what you'd expect is that that'll shift out of the latest data. Services, there we're seeing disinflation, so that's kind of good to see because that's the level. Remember, if you strip out the tariff inflation, the remaining components of inflation, which is goods and services, is what the inflation numbers will relax back to. And if you do strip out the tariff distortion, if you like, then underlying inflation, according to the Fed's estimate, is around 2.3 to 2.4%, which is not far from its target. So that's kind of good news. And if you look at what markets are expecting inflation to do, those expectations remain anchored at 2%, which is great news because it shows that the market and the economy believes the Fed is credible and it can get inflation back to 2%. So tariffs are certainly important. The Fed does see those as a kind of one-time shift in price levels. And like I say, eventually that's going to work its way through the system. And we don't see any evidence that it's going to become sticky and baked into expectations, which would be a problem. So the Fed must be hugely relieved that that's not the case. So the policy decision, they cut by 25 basis points, that's 0.25%. Now we're in the range 3.75 to 4%. They always do it based on a range, unlike the Bank of England. So it seems a little bit weird that they cut inflation. It seems a bit weird that they cut interest rates when inflation's still above target. But as I say, that's because of the balance of risks. We've got an upside risk on inflation versus downside risk on jobs. So these kind of pull in opposite directions. But the one which won this time is pretty much to do with worries about the jobs market. So that's a bigger risk than inflation according to the Fed's estimates right now. So is this going to be a huge change to the economy because of this 25 basis point shift? No, just modestly less restrictive now, a little bit less tight is the way you'd characterize it. So December, what's going to happen in December? And this is where there were real interesting things going on in the committee. Now, we haven't seen the minutes yet. We will see those later. But according to Powell, and he doesn't usually say this, there were some strong disagreements within the committee, according to whether people were more worried about one side of the mandate or the other. Where are the risks? Also, there's an issue with data. Now, Powell used the analogy of driving in fog. He's used it before. If you're driving with poor visibility, you don't put your foot on the accelerator or the gas, as they'd say in America. You actually take it much more carefully. So that's the analogy that the Fed is using right now. If you can't see the data, you'd be more careful with your rate cuts. And I think that's likely to be a reason for them to hold fire in December, even though the markets are pricing in a very high probability of a rate cut. And I can show you the probabilities in a moment. So he was very clear that policy is data dependent and they're not on autopilot for a cut in December, which is the next meeting in 6 weeks' time. Another interesting thing was to do with the balance sheet and quantitative tightening. And I might nerd out later on about the ample liquidity idea and what it means for the economy, but also what the Fed sees right now. But the goal right now is that on 1st of December, the Fed's going to freeze the size of its balance sheet. at least its holdings of treasuries and mortgage-backed securities. Now, if you do that, remember that what happens, there are other moving parts in the Fed's balance sheet. So if you freeze the size of your treasuries plus MBS holdings, and they are going to convert one to the other, I'll talk about that in a sec, but if you freeze that, if you look at other components like currency and non-reserve liabilities, those two are going to grow, and that means that the reserve balances are going to drift lower for a while. Now, that might be worrying because that means that banks can't lend to the real economy. So, what will happen is is it going to be a more gradual change than it would be if you did quantitative tightening, where you just let stuff run off the balance sheet and shrink the balance sheet? Because remember, if you're shrinking the size of the balance sheet, effectively you're tightening policy. So maybe that's not what they want right now. So they're going to freeze the size of the balance sheet for now. Mortgage-backed securities. Remember, if you're a US homeowner, your mortgage is packaged up inside these things called MBS, which are then, packaged, sold off, and then bought by investors. And a big chunk of the Fed's balance sheet is currently used up buying those mortgage-backed securities. They have a lot of them on their balance sheets, so they're going to let those carry on running off, mature, those MBS mortgage-backed securities, which are essentially just bonds, and they're going to take the money and not reinvest it back into the MBS, but reinvest it into treasury bills. Now that's going to shorten the duration of the assets which they hold and bring them more into line with the duration of the treasury market itself, which is fairly short duration. If you compare the US's outstanding stock of debt, it tends to be shorter dated than UK debt, for example, which can pose problems in terms of the transmission rate of monetary policy, and so it could give them more flexibility down the road. What was interesting, and this is something that Powell noted, is that if you look at things like repo rates, which are collateralized borrowing rates in the United States, those have been creeping up. And that suggests that liquidity might be drying up in the economy, and that's not what you want. So this is what's telling them that maybe there's a liquidity problem now. They don't want that to happen. So that's why they're freezing the balance sheet for now. They don't want to have a squeeze on liquidity at the moment, or ever for that matter. So what does that mean for the next 3 to 6 months? Well, moderate growth, no catastrophe on the GDP side. The labour market's gradually cooling. We're seeing disinflation resuming as the tariff effects kind of wash through the system. Ending QT should ease some of the money market frictions, which is good news if you're parking money in a money market fund right now because you're scared of the equity market, which many people tell me that they are. But, is this going to be a huge, is ending QT going to be a huge effect on the market? Probably not. I think it'll be very well managed by the Fed. So before I move on to talk about and take your questions and get Teddy up here to have a snack, let me just talk about the dissent, because that's kind of interesting. Because remember that Stephen Moran, who's also got one foot still back in the Oval Office, which is quite unusual, is the one that really wants to get a 50 basis point cut this time around. He was the only one that wanted that. He was one of the dissenters. Another person didn't want to have a cut today. So those are the two dissenters in this vote. But really the arguments were about what's going to happen in December. There wasn't much disagreement about this meeting. It was all about what's going to happen in December. And Powell actually said the words, strongly differing views. Now that's very unusual. So what is that telling us? Well, really, it's about how quickly we move now towards the neutral rate, which is itself unknown. But what looks like what's happening is that this committee is torn between these two different risks, which might be natural given that we're at the end of one of these tightening cycles. We're moving back to neutral. you could say that, or you could say that this is a takeover of the Fed by the US government, which isn't quite such a neutral reading on what's going on. That's much more worrying, of course. So, what are the risks that people see? Well, inflation on the upside, there's an upside risk of inflation. So some of the members of the committee are worried that tariffs are going to reignite inflation. They think the Fed is easing too early, and that the risk is that we're going to have a flaring up, almost like a forest fire, where you haven't quite put out the fire and you've got all these other inflationary forces re-emerging later on because they just haven't been careful enough to get rid of inflation. So that is the worry of some committee members. Whereas other members, probably Stephen Moran, think that employment's a much bigger risk. So, are we seeing the labour market weakening faster than is actually in the data that we can't now see? That's another part of the argument. So that's really where the frictions are in the committee right now. There's also a kind of philosophical divide in terms of risk tolerance. According to which side of their mandate they're more worried about. The other point, I guess, is about the neutral rate. And there was a piece of analysis which was put out by Stephen Moran about where the neutral rate is. And he came up with this incredibly low number, which is close to 0. Now, that's way out of whack when it comes to the rest of the FOMC committee. Certainly, if you look at their dot plots, they give you their long-run expectation for rates. And it's somewhere around, I think, just over 3%, 3 and 3.25, somewhere like that. But his is way below that. So if he thinks that's neutral, he's very much out of line with the rest of the committee. So I suspect that was also part of the argument today. It was about where the neutral rate is. And that's really important because that's where you end up when inflation goes away. You end up at the neutral rate. So if some of the committee members say it's at 0, some say it's at 3, well, that's vastly different. So that's probably going to be a huge bone of contention later on if Moran sticks with this very low neutral rate idea. Anyway, so that's my kind of summary of what's going on. I hope that was useful. And you can obviously watch the whole thing on YouTube yourself if you're interested. Anyway, let me just summon my cockapoo and we'll get some of your questions answered. Let's see if he's out there. I don't think he is yet. These are his special burger treats. So please do ask a question. Please do like and subscribe. If you like our content and you don't want to miss any new content. Oh, here you are. Here's your burger, my friend. He's gaining weight. I don't like to say it, but he's got this kind of harness that he wears when we go for a walk, and it's getting very tight. And even the dog walker said he seems to be gaining weight. But it's just his middle-aged spread, isn't it, Ted? I wish you could see his wagging tail, but you're going to stand up. You're going to do a trick. You're going to come over here. Stand, stand, stand. Good boy, clever sausage. That's it. That's all of the burger. All gone. All gone. Going to go down and get it downstairs. Good boy. Brilliant. So Laura's summoned him downstairs. Brilliant. So let me fire up my spreadsheet because Laura has a document for me. And this has the questions in it. And it's actually Sam Hill doing it today. Thank you, Sam. So Sam Hill's our community manager. If you're a member of our community, she does a cracking job kind of just helping people out. If you've got a problem with the community, signing up for our chat application, Sam sorts it all out. She's great. And she's also my lifeline tonight between your comments and this document I can see. So please do ask a question if you've got one. And please do a super chat because we'll push you to the front of the queue if you do that. And if you're one of our supporters on YouTube, again, we'll push you to the front of the queue in terms of answering your question. In fact, let me just share something with you. Let's see if I can find it. Michael, who does the podcast, Michael Pugh, who does the podcast, actually came across this hilarious thing on Reddit today, and he shared it with us. There's someone saying, oh, I want to know about personal finance podcasts. They've been on a kick for them lately, but they're all really hit and miss. Some start out great and turn into endless ads or the same recycled advice. Any UK-based shows you rate, always looking for good recommendations. And then someone says, Many Happy Returns is great. Of course, that's our podcast. It's by Roman from PensionCraft, and his co-host is also great. I agree with that. Michael's awesome. And then someone says, the co-host Michael is quite witty, but he's a Padawan compared to Roman's Yoda. It works well when Roman goes off the deep end with some in-depth explanation. Michael's there to rein him in. And then someone says, I'd maybe put him in as a Jedi Knight. He's late 30s and high up in an investment bank, I think. It's quite a skill to make something understandable without oversimplification. Spot on with the rein in, though. Roman can get carried away with the theoretical, and Michael is often more realistic and says what I'm thinking. Yeah, but come on. It's brilliant. And then the reply was, okay, Michael is on the Jedi Council, but we do not grant him the rank of master. See, I disagree with that. I think that Michael is a master now. He's so quick to learn. He's been great. And I definitely make him an honorary Jedi. Strong in the Force he is. Brilliant. So, do we have any super chats or any questions from our supporters on YouTube? No. So please do super chat and please do ask a question. We're at a more civilized time tonight, aren't we? This is great because of the daylight savings time difference between the East Coast of the US and the UK. Right, so let's answer some of these questions. Surprisingly quiet. Is everyone out trick-or-treating or a couple of days early? Soft focus, love it. It's not meant to be soft focus. This is my new camera, so it should be super sharp focus. Look, focus. It should be very rapid focus as well. There we go. Look at that. Very good. This is my new Sony camera. It's very good. It does overheat, so I might disappear later on. Fingers crossed it won't happen. Evening, Roman, Laura and Teddy. So this is Lynn 3051. Lovely to hear from you again, Lynn. Just a heads up from us, we'll be away until December. Oh no! They're going on a romantic weekend by the look of it. Involves champagne. Sounds great. Why not take us with you, Lynn? You know, we could just live stream, you know, round a fire, drink in hand. It'll be great. Hedge Fund 474, hi. Oh, we've got a question from one of our regulars. That's great. A super chat. Thank you. And this is from Raja Selan Ganaswaran. Lovely to hear from you, Raja Selan. I finally learnt to say your name a bit better. I don't stumble over the words anymore. So, super chat from you. Thematic stocks, VRT, data centers, opinions, hashtag FOMO. Okay. So let's have a look at this VRT fund. It's not actually one I'm familiar with, but obviously the theme is an important one. You know, you couldn't shut up the press today in the FOMC press conference talking about AI, data centers, because they're so important for the US economy. And, you know, Powell was talking about the net present value of data centers being high, you know, all this stuff, which is interesting. You know, it really is an important part of the US economy now. Some people say that that's actually what's holding the US away from a recession right now, which is possible, certainly. So VRT, Vertiv Holdings, is that the one you're thinking about, Raja Selan? Yeah, it looks like VRT. So let's pull this up on ShareScope, which I like. VRT. Vertiv Holdings. In fact, let's pull it up on Stockopedia because that could be interesting. Stockopedia, which is my go-to for single stock analysis. Right, let's share so you can see what I see. There we go. Right, so Vertiv, VRT. So what have we got? We've got a description of the company. That would be handy. Here we go. Vertiv Holdings is a global provider of critical digital infrastructure. So mission critical digital infrastructure and lifecycle services primarily for data centers, communication networks, and commercial and industrial environments. AC and DC power management. So it sounds like these people provide the infrastructure for the actual data centers themselves. So this is like the you're selling the shovels to the gold miners in the gold rush. In fact, this might be even a level away from that. You're selling the wood to make the shovels to give to the AI gold miners. So, let's have a look at its numbers. So revenue, I like that. The forecast is for an exponential increase. We love that. Net income, also very important, and normalized earnings per share, also trending upwards, and is expecting a boost, according to this, in 2025 and 2026, also good. Valuations, predictably high. So currently 41 times forward earnings, I think, between 41 and 150, so huge. And of course, no dividend because it's a growth company. So yeah, I mean, just on the face of it, that looks interesting. The sector is interesting because obviously it's in a hot sector right now. I guess my only concern is that there's going to be overcapacity in this sector at some point. But let's take a look at the three critical numbers. The quality ranking is 92, so very strong balance sheet, good earnings growth, not too much leverage, so good quality. If we look at the value, very low. So remember, this ranges between 0 and 100 compared to the rest of its market. So this is on the 7th percentile, and momentum very strong. So 2 out of 3 is okay, but it ain't cheap. Ideally, this would also be not so low. So the overall stock rank is 77 because of that very low value rank. But good quality company, good quality balance sheet, which is strong, good momentum in earnings and price, and but it's overvalued potentially. So if there is overcapacity, remember, what's going to happen is that there'll be a very rapid derating of these companies. Now, if that happens, well, this is going to be one of the casualties. Now, that's not to say that data centers won't be needed. Of course they will. But if we're building too many too quickly, then overcapacity only ends one way, which is a fall in share prices for the companies that provide the infrastructure. And presumably there'll be a fairly brutal pullback in the US market overall, and potentially a weakening in the US economy because of its dependence on data centers. So that is a concern, I think. But look, the music's still playing, so maybe this is an interesting buy. I don't buy single stocks except for my fund portfolio, but this is certainly something I'd consider based on what you've told me. So, thanks for telling me about it, Roger Selan. I hope it works out for you. Let's have a look at the questions. What other questions do we have? Right. Everyone, welcome. Yeah. We'll be having a slice of cake. That's their handle. Says, I recommend eating less cake. Is this a reference to Teddy's... Oh, no. Bonkers About Alice said, just worried how fast everything is gaining. I think they were referring to the equity market, but who knows? and then we'll be having a slice of cake suggested eating less cake. That's quite surreal. How are we doing with the questions? Okay. Someone's saying, great job, Sam. I agree with that. Thank you, Samantha. Good evening, Roman. I'm getting very good rates in my Vanguard Global Fund, 22%. This seems extraordinary. Extraordinary. What's your view, please? Yeah, I mean, if you look at global funds generally, they're all doing well, largely because of the US and largely because of the mega caps, the mega cap stocks, which are dominating all global markets right now. So let's have a look at various global index funds. Let's just pick out a handful of these. Again, let me share so that you can see what I'm looking at. So the one I use currently is, I used to use FWRG. It's this one from Invesco. I'm currently using, I'm using the Acqui one. I wonder if it's on this list. Yes, it is. Here we go. So let's plot these two along with the one from iShares, which is MSCI World. So all three of these are sterling denominated. They're all global funds. One of them, the iShares one, is just developed markets. I wonder if there's an all country world from iShares. Yeah, let's pull that up. Actually, that might be better. So Acqui, and let's do FTSE All World. Why not? VWRP. So let's plot these three. All accumulation. Oh no. All accumulation. There we go. So let's have a look at the returns. Yes, and they're all almost identical, which is exactly what you'd expect because they track global equity. We can look at the composition of them in a moment, but Nvidia just crossed the $5 trillion threshold. I think it was today, and they're all dominated by the same mega caps that you'd expect, including Nvidia. But yeah, I mean, it's just tearing upwards. Why is that? Well, of course, it's because of the US market. That's the one that's really pushing things higher. So that's year to date. Let's have a look over the longer term. Let's have a look over 5 years. I wonder if it goes back further. Probably not, because some of these were issued quite recently. I know the Vanguard one's been around for ages. So is this one. So let's just focus on those two. Yeah. So now we can go all the way back to 2019. And you can see that after we had the huge sell-off due to the tariffs and Liberation Day, we had a really rapid recovery, and we've just been surging ahead since then. And really, it's been about this AI narrative, and that hasn't imploded yet. If anything, it's got more speed. Does that worry me? Yes, it does in a way. But if you listen to what Jerome Powell said today, this isn't like the dot-com bubble where we had companies that were just ideas. They weren't really companies at all. Now we've got revenue growth, we've got fundamentals, we've got profits. So that's the huge difference between now and the dot-com bubble. And in fact, a video I made recently was that distinction. What can we learn about the AI bubble? How can we survive the AI bubble with what we learnt from the dot-com bubble? And there are certain things, I think diversification is important. Don't get drawn into, taking even more risk with buying the successful stuff. Some people are buying levered Nvidia because that's what's been doing well. But I think that's a mistake because, of course, that's what's successful right now. But if there is a reversal, then it'll be brutal for that very narrow leadership of the global markets right now. Let's just have a quick look at Nvidia because I think its growth is just astonishing, and it's just taken another leg up. Here we go. So I've overlaid here the blue line, which is MSCI World, and that is a global index. Well, it's not global; it's developed market index. You can just see this huge surge we just had in Nvidia, which has taken it over the 5 trillion market cap threshold, which is amazing. This is a company that's trading like a small cap, but which has a market capitalization of $5.04 trillion. Amazing. And if we look at the earnings growth, where is it? Income. Yeah, just look at this earnings per share graph. It's just going vertical. So it's not like this company is not justifiably expensive. I think it is. And it's really at the epicenter of what's going well for the US economy. So kind of justified, I think. But let's have a look at Nvidia here as well. Now I'm guessing that the valuation rank will be low. Yes, it is. 4%. Right. But fundamentally a good company, good quality, good momentum. Same as the Vertex stock that we just saw. But very, very, very expensive. That's not a reason not to buy, of course. If you're willing to take the risk that everything's going to continue fine in the future, then why not? But yeah, I'd be concerned about that. So all I'd say is don't get caught up in the narrative, keep it diversified. If you are going to do an overweight in the stuff that's been successful, don't make it too large. The people I'm speaking to at the moment, one-to-one, are actually doing the opposite, which is tilting away from this. But, you know, personally, I'm just keeping it market cap weighted. So yeah, Nvidia is it is my biggest holding, I guess. And it's been doing very well. So thank you, Nvidia. But I wouldn't tilt more towards this theme, this narrative right now. And if you're really contrarian, you could tilt towards value, which is the opposite of what we're seeing do well right now. So, you know, is this a kind of junk rally? Maybe. But it's hard to call a company like Nvidia junk with margins of more than 60%. You know, very weird situation. But gold is starting to kind of sell off. That was also interesting. And it was funny because on the podcast, I was joking with Michael. He said, if you don't believe in the debasement narrative, this is another narrative that's been going around recently, what would you do? And I said I'd short gold or silver. He said, oh, that sounds very risky. But, you know, I wish I had now. But, yeah, I have seen a fairly brutal move downwards in gold recently. So back to your questions. And I'll just see if we have any more super chats. So we'll have a couple more questions and then we'll end. And remember that I will be covering the Bank of England, which is next week, 6 p.m. on the 6th of November, right? So the day after Guy Fawkes Day, which we have here in the UK, but not in the US, obviously. Let's see, what do we have for other questions? Lucky you escaping. Oh, they've got 5 weeks in Australia, Lynn. That's incredible. Oh, that sounds wonderful. And of course, it's their summer that you're just entering now. That would be great. How much do you think a long US government shutdown is going to affect future Fed decisions? Do you think flying blind will have serious impacts on US inflation? You know, maybe it's worthwhile reading out what Powell said about this himself, because he did comment on it. Let me just find it if I can. Something he kind of said he didn't know. I seem to remember. If I search for the word anecdote, there was a really nice question from one of the journos. Here we go. I think this is Howard Schneider from Reuters. He said, do you worry at some point you're going to have to start making policy by anecdote? In other words, you know, I can talk to the bloke down the street and see how it's affecting his business. You know, is inflation a worry? Which was an amusing way of putting the question. And Powell said, this is a temporary state of affairs. We're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that, you know. What do you do? And if you're driving in the fog, you slow down. And that's how we got onto the kind of fog topic. But yeah, if it is a worry for the December meeting, then they're going to have to be more cautious about cuts, and that means less likelihood of a rate cut. And I said I was going to show you the expectations. Let me quickly share that as well. So every one of these that I do, and I've done every one for several years now, every FOMC meeting, I take a snapshot of the market expectations about what's going to happen. So for today, you can see there was a 98% chance that they cut by 25 basis points, and that's what happened. If we look at December, so the December the 10th meeting, you can see that there's an 85% chance of another cut, 14% chance that they'll keep it where it is. So pretty high, especially given the fact that Powell was saying it's not a done deal. Now, if the data's weak, what I'd expect is that that probability wouldn't be as high. I'd say there's more chance of them keeping it at 375 to 400 basis points and just waiting until the data kicks in again, and then they'll have a better idea of what's going on. But Powell said, look, if something dramatic is happening in the economy, they've got enough data that they'll know it. You know, they'll be able to tell that something's going badly wrong with the employment data. And remember that there aren't just publicly available data that's created by the government. There are also private payrolls surveys. So, you know, they can use those in order to kind of fill in the gaps. So it doesn't help, of course, but I would expect that this is going to, if it carries on, it's going to make it more likely that they wouldn't cut in December, you know, as they become more cautious. So I hope that answers your question. And if we don't have any more super chats, I think I'll answer one more question and then we'll bring it to an end. Alan With says, with interest rates dropping and financial conditions easing, would you say it's genuinely risk on for equities, especially AI and growth, or could this still be a trap if the cuts come from slowing growth? Yeah, I'd say it's risk on for equities. Remember that if you cut interest rates, it's good for stocks. It's hard to see this narrative being shifted and the optimism being removed while we see things looking okay. In fact, I just shot a video about one potential problem, which is in the private credit market. So we have seen First Brands and a couple of other defaults due to issues with the private credit market. So there are various contagion mechanisms which could trigger a more widespread problem for the US economy if the private credit market really does come a cropper. Primarily it's through the banking system, because banks have lent to some of these entities which could themselves be problematic. So that's one transmission mechanism. I came up with 5 others in the video itself. But anyway, that's a video which is incoming. I probably will publish that in the next couple of weeks. So that's one we're going to publish. But I found it really interesting researching it, and you know, I think that could be one of the catalysts which certainly puts a pause into place for this narrative and maybe causes a re-rating of US stocks. A good old-fashioned credit crunch, you know. Wouldn't that be great? But I think valuations right now are kind of crazy. It is overblown. There is too much euphoria in the market. It's clearly a bubble, an AI bubble. But, you know, what should we do about it? Well, I'm doing nothing. I'm carrying on with my equity holdings. I'm not really de-risking. I have to kind of de-risk because I've got enough money now. So, you know, I don't need as much equity as I did, but not because I'm scared about valuations. I don't think that's true. Anyway, I hope that was a useful session. I hope that you learned something about the Fed and some of the decisions today, learned something about the US economy. And don't forget, next week on Thursday, we'll be doing this again, but in this case, it'll be for the Bank of England. So 6 p.m, November the 6th, you can join us again. Don't forget, many happy returns, our podcast. That's entertaining. We just saw some of the comments about it, quite amusing ones, with me and my Padawan, Michael. So do join us for that. It's completely free. We've got a newsletter, pensioncraft.com/newsletter, if you want to sign up for that. Again, free, like almost everything that we do. And if you did want to join our membership, that's paid for. Go to pensioncraft.com/membership. We've got quite an exciting release of our tools, which is going out this week. I've got to make some videos about it. But that's going out for our members as well. So you can back test your strategies using actual fund data for the funds you own, which will be great, I think. Anyway, lots going on, and I expect the Bank of England will also be interesting to see whether they've cut. And thank you for joining us, and good luck with your portfolios.